Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. The allure of luxury real estate is powerful. We often equate high price tags with guaranteed high profits. In this context, luxury typically means high-end real estate, such as pricey urban condos, sprawling new developments, and expensive second homes in desirable locations. These properties usually cater to the top percent of buyers, often requiring specialized financing and offering exclusive amenities. However, the easy money years are over. As the economic situation has changed dramatically, rising construction costs, higher borrowing rates, and general market uncertainty are cooling many sectors. This shift exposes a critical problem: oversupply. When developers build too many properties too quickly in anticipation of never-ending demand, the market becomes flooded. Your goal as an investor is simple: avoid placing capital where supply exceeds realistic demand. Otherwise, you risk poor returns, high holding costs, and a lengthy wait to sell. The warning signs. How to spot an overbuilt luxury market. Smart investing starts with spotting danger before it impacts your portfolio. In luxury markets, the key data points signaling oversupply relate directly to inventory and pricing behavior. These indicators are often easy to track and shouldn't be ignored. Too many homes for sale, high inventory. Inventory measures how long it would take to sell every home currently on the market, assuming no new homes appear. In a healthy real estate market, this number is typically low, maybe 4 to 6 months. When dealing with overbuilt luxury markets, that number can soar past 10 or 12 months. This means there's a heavy imbalance. When inventory is high, buyers hold all the power. They know they have endless options and no need to rush. Sellers, on the other hand, face a waiting game or must make significant compromises. Investing here means your potential returns are constantly under pressure from the sheer availability of competing properties. High inventory signals market stagnation, which destroys investor profitability. Price cuts become normal, not special. In a truly healthy luxury market, a price cut is rare. It usually suggests an initial pricing mistake, not a trend. In an oversaturated market, price cuts become commonplace. Repeated price reductions on expensive homes show that the initial high price expectations were simply unrealistic. If you see listings repeatedly dropping their asking prices, it reveals a fundamental mismatch. Sellers are hoping for 2022 prices, but buyers are only willing to pay current reality prices. This consistent need to cut prices is a massive red flag for any investor. It indicates that the previous valuation methods are flawed and that future resale values will be significantly lower than projected. A flood of new construction, too many cranes. Take a look around the intended investment neighborhood. Are there numerous cranes, newly cleared lots, or sales centers promoting properties that will be finished in the next year? This crane count is a simple, if anecdotal, metric that points directly to future oversupply. When developers rush to complete luxury high-rises or sprawling communities, they create competition for existing and future units alike. Buying a $3 million condo today is risky if 300 identical, brand-new units will hit the market next year across the street. This coming supply ensures prices remain suppressed for years as the market slowly absorbs the excess homes. A high volume of ongoing construction simply confirms that your timing is poor for an investment. Markets to skip. Where luxury oversupply is hitting hardest. While every geographic area is unique, certain types of markets are structurally more vulnerable to luxury oversupply corrections. These are the locations where developers often become overly optimistic about sustained, high roller demand. Coastal condo canyons. Avoiding the high-rise glut. Slick, High-end vertical communities built along desirable coastlines, think certain Florida stretches or parts of the Pacific coast, often experience this problem intensely. Developers frequently target international buyers or wealthy individuals looking for a second or third home. The trouble starts when these markets become reliant on a steady flow of global capital. When global economic sentiment shifts, these buyers retreat quickly. Developers, however, are now left holding towering structures full of empty apartments. Reliance on tourism. If the local economy depends solely on seasonal visitors, extended vacancies are common. High carrying costs. These buildings usually demand enormous homeowners association fees for services like valets, spas, and 24-hour concierges. Identical inventory. Every high-rise unit often looks similar, intensifying competition and removing scarcity. These condo canyons face high vacancy rates and flat sales projections because the initial demand simply didn't match the supply rush. Understanding which markets are oversaturated can protect your investments and maximize long-term returns. Do your research, think strategically, and stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.